QuickBooks Online 2025, looking at the vendor cycle overview. The vendor cycle could also be called the expense cycle, the purchases cycle, the pay cycle, or possibly the accounts payable cycle. Get ready and some coffee because we're going to save time with QuickBooks Online 2025. We are online in our browser, searching for that QuickBooks Online test drive, the free sample file available to everyone, provided by Intuit. Intuit being the owner of QuickBooks. Looking for the result that has Intuit.com and the URL, that giving us some assurance that we're in a valid link, given the fact that Intuit is the owner of QuickBooks. You might have to then verify that you are not a robot, so you can do that if asked. We're then going to be in the sample file, which is going to be Craig's Design and Landscaping Services. I'm going to open up the major financial statement reports, balance sheet, and income statement, which will be our routine just about every time we go into our QuickBooks file by going to the reports on the left-hand side within the standard tab. Right-click on the balance sheet, open link in a new tab. You can see it populating up top. Right-click on the profit and loss, open link in new tab. There we have it. This first tab is where we're going to do the data input. Second tab is going to be our balance sheet. I'll close the hamburger up top. And then the third tab is going to be our income statement, closing up the hamburger. Let's go back to the first tab. This is our data input tab. In prior presentations, we discussed general navigation in a web-based type of system, as well as where the normal data input items are. They're either up top, kind of in the ribbon, mainly in the cog up here, or on the left-hand side, the left panel. The main forms we can enter can be found in the plus button, them breaking out by cycle. So we then discussed the overall accounting cycle, noting that you can think of an accounting cycle as something that happens kind of on a yearly cycle. And then you could also think within that on a monthly cycle, because at the end of each month, you're going to do the bank reconciliation, which kind of closes out the month in essence. But within each cycle, we also want to think about the cycles by customer, vendor, and employee. That will help us to envision what is happening. And that is also what you'll be thinking about if you were to get into a larger company, breaking down the tasks into particular cycles. So that's what we'll be doing now. This time, we want to look at the vendor cycle. So the vendor cycle you can think of as in overall, in essence, it's the cycle where the money is ultimately going out of the company in order to help to generate revenue, typically for expenses, things like the utility bills, the telephone bill, the internet, and so on and so forth. Now, as we look at the cycle, you will recall that we're going to have the foundational things in place first in order for us to enter these forms that are related to each of these cycles. The foundational things being the chart of accounts, for example, and any kind of other items that we need to be putting in place that would typically be for the customer side of things. We're going to talk about that in the second half of the course when we reconstruct something from the ground up. Right now, we're kind of deconstructing, so we're going to look at these forms and see how they're impacting the financial statements on the right-hand tabs up top. So you'll note that first, some terminology. When we think about the vendors, that's going to be the people that we buy stuff from. So from our perspective, from a cash perspective, ultimately money is going to be going out from us in order to purchase things. The reason we purchase things is because we need to use them for our goal in a business sense, that being revenue generation. Now notice in normal parlance, we are also vendors because you can think of it as both sides of the table. So we actually sell stuff. In our case, in this case, we're a landscaper, so we sell our services for landscaping, and so we also sell things. But when we're thinking about the QuickBooks terminology, we have to think about one side of the table. So in a more broad sense, when you say vendor, you might talk about someone who sells things, and oftentimes we're thinking about physical things rather than possibly services. But from a QuickBooks terminology, we're thinking about the side of the table where we are buying things from a vendor, and therefore ultimately it's going to be money going out for the purchase of those things. Now, this is a cycle where if you're a small business, it might be the easiest cycle to automate and make basically automatic, because most small businesses will be paying for things possibly electronically these days, rather than having to write checks all the time, which adds a level of complexity, which we'll talk about shortly. You might have electronic transfers to pay the utility bill, the phone bill, and so on and so forth, making it easier to record those with bank fees because there's not a big timing difference, and therefore you can basically automate the process, paying all of your vendors basically with an expense form, but rather than you entering the expense form when it happens and then reconciling it to the bank account, you just wait till it clears the bank account. So that is great. However, there are some cases where you might not be able to do that, and if you get into larger types of businesses, it's likely that you're going to have to do a full service accounting system. The reason I don't call that a full service accounting system is because basically in a full service system, you would enter the information on our side in the books, and then the bank would be doing their thing on the cash going out on their side. We would reconcile the two with a bank reconciliation, and that would give us double assurance. It's a huge internal control. If we just wait for something to clear the bank, get the information from the bank in order to record it, we're doing a lot less of an internal control. We're just dependent on the bank as opposed to having two different people record things. Now, again, for a small business, we're going to do that because it's easy to do that, and we have fairly good reliability on the banks given the speed of transactions and so on and so forth. But for larger businesses, you're going to more likely have to deal with accounts payable, meaning we're going to enter a bill type of form, and that is because larger businesses are going to want to hold on to their money as long as possible. For example, if you're paying a $75 utility bill for a sole proprietorship, it doesn't matter if I pay it today or, at the very last day, 15 days from today. But if the bill was $7,500 and or I had thousands of those bills, holding on to that money for another 15 days could greatly increase my cash flow and have a time value of money impact given the fact of inflation, right? For a small business with small transactions and a small number of transactions, the impact of 15 days is possibly not relevant, and therefore we can kind of ignore it. With big transactions and a great number of transactions, 15 days for all those larger transactions is going to be significant, and therefore we're going to have to really manage the accounts payable and try to pay our stuff off as late as possible because that'll improve our cash flow. So that's going to be the main thing here. So let's jump over to our flowchart. So the flowchart is over here. Now this is the QuickBooks desktop flowchart. We're doing QuickBooks Online. I'm just using this flowchart because it's a great flowchart for any kind of accounting system, and the forms for the desktop are basically the same as the online. So we're going to be in the vendor cycle. So remember, we're breaking out by cycle: vendor cycle, customer, employee cycle. If you're in a situation where you have a fairly basic business, then you often might be able to be on a cash basis for the vendor cycle. Now note, if you're on a cash basis for the vendor cycle, it doesn't necessarily mean that you're going to be on a cash basis for the customer cycle. Why? Because on the customer cycle or revenue cycle, you might have to invoice people, such as if our landscaping business did the work first and had to bill the client. That's just the way it is for landscapers oftentimes. I can't just be in a cash-based system. I have to do what's the custom for the business that I'm in. But even if I have to deal with accounts receivable over here, that doesn't mean on the vendor side, I'm going to have to deal with accounts payable. So on the vendor side, I'm still going to be, in essence, on a cash basis if that would be the best thing to do, just waiting until the expenses clear the bank, recording them with the bank feeds with the check form, or that would be equivalent to, in essence, an expense form that's generated from, in essence, the bank. That's why we want to think about this basically in terms of cycle. Now, one other technical point with the terminology of accrual versus cash-based system. You can kind of choose to be in an accrual or cash-based system, but what you're really doing is doing the easiest thing most of the time and being forced to be on an accrual or cash-based system depending on the type of industry you're in. So, for example, on the vendor side of things, we can say, hey, look, I'm just going to pay for everything with the check form when the check becomes due. So when the utility bill becomes due, I'm just going to electronically pay it and record it with the bank feed. That would mean I'm in essence on a cash-based system. But you can still technically say, well, no, I'm also on an accrual-based system. It just so happens that that transaction is the same under an accrual-based system or cash-based system. Why? Because there's no timing difference between, in essence, when the work was done and when we paid for it. In other words, if it's a telephone bill, we got the bill basically right after the month that we incurred the service, we used the telephone. Then on an accrual basis system, I would record the expense at that point in time because that's when I incurred the expense. I used the telephone. But on a cash-based system, I would still record it at that point in time because that's the time that I actually paid for it. So you can, technically, you could say I'm on either an accrual basis or a cash-based system, but it just results in the exact same transaction because there's no timing difference between when the work was done and when you paid for it. When you enter a bill, then there is a difference, right? So now when you enter a bill, accounts payable went up and you didn't yet pay for for it at that point in time. That means you're going to basically have to be on an accrual system because you're going to have to track the accounts payable, right? You could try to toggle in QuickBooks and be on a cash-based system, in which case it's just not going to record the bill until you pay the bill. And that's what the toggling between the cash and accrual basis is in essence doing. All right. So if we're on the vendor, let's think about the easiest system that we can have. That would be one where you just pay for the bills as they go through the bank feeds. We would use a type of check form, although it's going to be an expense form. Typically, if it's an electronic type of transfer, that would be the easiest thing to do. And it's usually not so dependent on the industry, but on the size of the business with the vendor side of things. As the business gets larger, you might have to track the accounts payable more, as we discussed. Now, some people still like to actually write physical checks. If you write physical checks, then you have more of an issue with the bank feeds. You're still kind of on a cash-based system, but I can't wait till the check clears the bank, or I could, but I don't want to wait till the check clears the bank and then record it when the check clears the bank because I have the added problem of the check has to go from me to the other person and they have to put it in their bank and their bank has to talk to my bank, meaning there's a huge timing difference between when I write the check and when the check clears, when the bank knows about it. So what I want to do is track whether that check clears. Did the check get lost in the mail? Did the other person not cash the check? How could I know that? Well, I have to enter the check on my side and then wait till it clears the bank so that I can see that the check has cleared. So if you're still writing checks, then you can't really just be, you're still on a cash-based system because you're writing the check, we're entering it into our side, but I can't wait till it clears the bank in order to have the check clear the bank because I want to write the check and then double check that it clears the bank with a bank reconciliation. The fact that we have electronic transfers lowers that timing difference. So instead of it taking a week to 2 weeks for someone to clear the check, it only takes like 1 to 3 days. So that means that timing difference allows me to, and I have a lot of assurance that it's going to happen timely, and therefore I can just wait till it clears the bank and I can depend on the bank. So I have more trust, more faith in the system, and therefore I'm just going to let it clear the bank is the general idea there. So if you have checks, it's going to be a little bit more complex. If you're just doing electronic transfers, that's going to be easier. If you're a bookkeeper, that's what you want to try to convince your clients of typically. It's like, dude, you got to put away the checkbook. It's making things a lot more complicated. It's a lot easier if we can do the electronic transfers because then we don't have to enter the actual checks. We can just wait till it clears the bank and automate the whole system with the bank feeds. Not only that, but when they come through on the bank feeds, they're going to tell us the vendor who you paid for with the check rather than having to look at the canceled check. So that's going to be a lot easier typically. All right. So the next complication is that if we have to enter bills. So now we're going to say, hey, look, when the utility bill comes due, when the telephone bill comes due, I don't have to pay it right away. I don't have to pay it for like 15 days. So what are my options? I could put all those bills on my desk or sort them in my email or whatever. and then wait till they're due and then pay them with like a check form or electronic transfer. That's kind of tedious to do, especially if you have a lot of them. And therefore, what you're going to want to do is enter a bill typically if you want to pay them as late as possible, which you might want to do for cash flow purposes, for example, so that you can hold on to your money for that extra 15 days. That will be more significant as we have more transactions. And then we can sort these in the system. We can sort the bills in the system by due date, trying to make sure that we pay them as late as possible. That's the whole game of accounts payable. What are you trying to do in accounts payable? I'm creating value for the business by taking all these transactions and paying them as late as possible while still being able to take advantage of cash discounts if they offer cash discounts in order to get paid sooner, and while hopefully not making the vendors angry with us by delaying the payment past what they want us to delay it for. So we want to be on good terms with our vendors, not piss them off. We want to take advantage of cash discounts, but then pay as late as possible in order to hold on to the money as long as possible to improve our cash flow situation, as well as take advantage of the time value of money. So when we enter the bill, we're doing an accrual type of thing then. That means there's no cash involved. It's increase in accounts payable. Accounts payable is an accrual account. We don't have it if you're on a cash-based system. And then the other side's going to the expense if we're paying for expenses, and then we're going to have to pay the bill. Now, the pay bill form is just an expense type form or check type form, meaning a form that decreases the checking account, but it's going to be a special one in QuickBooks so that we know that if it's a pay bill form, it's paying off a bill, meaning it's decreasing accounts payable. So we'll talk about these forms in detail later. Now, then you have the inventory. If inventory is involved, that's going to throw a wrench into the system because inventory also has an accrual component to it, and inventory kind of crosses over between the vendor side of things and the customer side of things because, of course, we first have to purchase inventory and then we sell the inventory, right? So it's going to be part of both the purchases cycle and the customer cycle. So for the inventory then, the question is, how are we tracking the inventory? Do we track it within the accounting system or outside the accounting system? If you have something like a Shopify store, for example, you might track it outside of the system in the Shopify store, entering it into the QuickBooks system periodically, tracking inventory, therefore, with a periodic inventory system. Otherwise, you're just going to pull in a whole bunch of information into QuickBooks, which might overwhelm the system and make it more complex than it needs to be. However, sometimes you might be tracking the inventory in the system, which means you're doing something similar to most stores that you go to. If you go to the grocery store and you check something out at the grocery store, then of course you can see the sales side of things, but the system is actually recording at the same time the reduction of the inventory and the related cost of goods sold at that point in time. So we have capability to do that in QuickBooks, although more complex inventory needs is usually when we have to have more customization. So we will be looking at a perpetual inventory system in our practice problem. Now, if you have a perpetual inventory system, then you also have the question on the purchase order side of things. The purchase order is like a request for the inventory. So, and that's a little bit different than what we're normally used to purchasing for ourselves. In other words, if I buy something from an online store like Amazon, I usually have to pay for it at the point that I order it. And that means it's basically mine even when I place the order, in essence. I already kind of own it and I'm kind of responsible for the shipping, in essence, in some respects, right? Well, I won't get in that in detail, but a purchase order would mean that you have more control over things. You're going to be saying, I request 1,000 teacups or something like that or whatever. But I'm not paying for it until you actually ship it to me. So then they're going to ship it to you, and then you're going to have the bill, you can imagine, in the box that has been shipped to you, and then we take the purchase order and record it into the system basically with a bill. So if you're dealing with inventory, you may or may not have a purchase order depending on the type of system that you have with your vendor. And then you're going to have to enter the bill. But as you enter the bill, you have the added complexity of tracking the subledger for inventory, meaning I don't need to track only the dollar amount, which is what I need to do normally with a bill or a check when I pay like the utility bill, but rather I also have to check the units of inventory, because I have to track the units of inventory in order to physically see the units of inventory to know when people are stealing the inventory or something like that. And then, of course, we're going to pay the bill for the inventory. So we'll get into the purchase order and the inventory. And so, again, if you don't have those two items, then you have a more simplified system, and you might be able to say, well, that's great. I don't need to deal with the inventory. I don't need to deal with bills. All I'm going to do is a check form with an electronic transfer. That's great. That's what we're trying to figure out here. However, there's one other huge thing. That's going to be taxes, and it's going to be a type of usage tax. In the United States, that would be a sales tax. And the United States, we have a federal income tax system, which is an income tax, but then on the state and local side, you might be also subject to state and local sales taxes, and that's going to be a complication as well. Now, taxes are kind of messy, because the idea of like a usage tax is that you're applying the tax to the customer. The customer's paying the tax, but you, the business owner, have been made into the government's collection arm, which is kind of sad. I hate that. But that's what happens. So on the sales side of things, we're going to have to record the tax with an invoice and the sales receipt. And so that'll impact the sales documents as well for us to determine what is going to be paid. But you can think of the tax as also a payable item, because, of course, we're going to be increasing a tax payable. We're not going to be able to keep that money. We've got to then pay it to the government in order for the protection money or whatever the government is providing to us. Not too much protection over here in California. Hopefully it's going to get better now, but we're paying them for the protection money, for crying out loud. Do your job, government. So anyways, that's the idea. So if I go back on over here, that's going to be the cycle. So we've got the vendor items. Here's the forms: the expense form, typical form, the normal form, the form that would be in the bank feeds, the check form if you're still actually writing checks, and that'll take longer to transfer, the bill form, increasing the accounts payable, the pay bill forms, which decreases the accounts payable, which is in essence the same as a check or expense form. In other words, a form that decreases the checking account, the purchase order, which would only be used if you have inventory. Not only that, but you're requesting the inventory. And then we'll get into some more of these possibly more abstract forms that you don't use quite so often, like a vendor credit. We've got the credit card credit, if you're paying for things with a credit card, which acts in a similar fashion as the bank account, noting that you could also handle that with bank feeds as well, because it has the capacity to use bank feeds. And then you got the print checks. If you're actually physically writing checks, you have to actually order the checks and print them, which as a bookkeeper is a painful and annoying thing to do these days when everything could be electronic, and therefore it's hard to convince old timers to stop, to put away the checkbook and try to do things electronically because they don't feel secure with that. So maybe there could be a niche in the business these days to deal with checks more for certain types of businesses, for people that they just like their checkbook. But if you're trying to automate everything, then you're trying to avoid checks typically, because that's going to make things messier. And then add the vendor. So quick look at our transactions tab on the left-hand side. This is going to be the bank transactions. So we'll talk about bank feeds later, but just remember that if you have everything electronic, then what's going to happen is if you pull the information in from the bank feeds, then you're going to see the decrease amount of the money, and then you're going to see in the detail, the description will possibly give you who you paid, which will be something like Verizon. If it was a telephone company, it would be the rental company, whoever that is, if you're paying the rental bill, and so on and so forth. And that information then can be typically used to know which expense account you should point it to: telephone, rent expense, utilities, and so on and so forth. That would be the general idea. Now remember that if you actually write a check, what's the problem here? The checks will still clear over here, but the date is going to be way later. It's not going to be close to the date that you wrote the check, and it might not have the detail for the transaction type because it wasn't an electronic transfer. So you might have to look at the actual canceled check if you wanted to wait till it clears the bank to record the item from the bank feeds. So that means that if you're doing the checks with a checkbook, whether you're handwriting the check or actually printing the checks from QuickBooks, you basically want to put them in the system when you create the check, and then use the bank feeds to reconcile. So you'll see it on the bank feeds, but instead of the bank feed recording the transaction, it's just going to reconcile the transaction so that it'll be part of your bank reconciliation process. Remember, either way you do it, the bank reconciliation is really important. Although, if you have just simply constructed your books from the bank, then the bank reconciliation is going to be very easy because it's going to tie out exactly to what the bank statement says because you built your bank statement from the books, but you still want to do it because you want to make sure that you didn't double enter something or not enter something. If, however, you enter something on your side because either you have bills, you have to deal with sales tax, you have to deal with inventory, or you have to deal with checks, then you're going to have at least part of the transactions over here that you already entered. They're still going to integrate the bank feeds, but the bank feeds will simply verify the transactions that you have entered, which is actually a more full service bookkeeping and accounting system, giving you a higher level of internal controls. So next time we'll go into the vendor center over here, which is the expenses tab, and we'll talk about how we track these items in this center, noting that this center is not as important if we're not tracking the accounts payable. If we are tracking accounts payable, then you're going to spend a lot of time in here, especially if you're in the accounting department working in accounts payable. You're going to be in here all the time dealing with bills, right? Tracking the bills and trying to pay them as late as possible.